This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, in terms of the computations for IHT that we've seen so far, we have seen those computations that are required by the death of the taxpayer. Should the taxpayer die, the most likely outcome we suspect in any exam question we see, the occasion of death creates two IHT computations. The first, lifetime transfers chargeable when made. The second, the chargeable estate at death. In relation to those lifetime transfers chargeable when made, we've only dealt in our examples with pets, those potentially exempt transfers. We also said, of course, that there was another type of lifetime transfer known as a CLT. That stands, of course, for chargeable lifetime transfer. Those transfers are only transfers made into trusts. All we know about them is that they would be both, as the name implies, chargeable when made, i.e. in lifetime, and if you died within 7 years of having made such a CLT, then possibly there may be additional tax to pay in relation to that CLT. Those computations we have not as yet seen, but all being well, later in this lecture, you will see. That, of course, may roll over till the next one, but it's likely to be hopefully done and dusted within this lecture. But at the moment, the only type of lifetime transfer, and that's going to be now consistent with what we do here, the only type of lifetime transfer that we've seen that is chargeable is that is only chargeable on death, and that's pets, those potentially exempt transfers made within the 7 years of the date of death. And what we've seen and what we have discussed but not yet seen the detail of, hence now section 5, is if tax is payable on any of those pets, i.e. we've reached a point where the pets over the previous 7 years, starting with the earliest year first, have gone above on a cumulative total the nil rate band of 325, that then tax becomes payable at 40%. However, if that pet, though within 7 years of the date of death, and is therefore chargeable on death, if it is more than 3 years from the date of death, though less than 7, then although tax is to be paid in relation to it, any tax charge itself may be reduced by taper relief. The concept is a simple one, inasmuch as if a taxpayer made such a pet in lifetime, and then 6 years, 360 days later, so one more week for the 7-year anniversary, and therefore what was potentially exempt when made would in fact then be exempt because you'd survive for 7 years. But 6 years, 360 days after the lifetime transfer, after the pet, 1 week before it becomes exempt, tragedy falls or arises or strikes here. A tragedy. Our hero, instead of being on the bus to work each day, as normally he is instead under the bus. Very bad news. Now, it would then seem somewhat harsh to say, right, that's within 7 years of the date of death, therefore any amount in excess of the available nil rate band is fully taxable at 40%, and there's no reduction in that tax charge. Where if the individual had just survived for another week, got to the 7 years, there'd be no tax at all. So rather than just that one, pardon the pun, deadline here in relation to the chargeability, if it's within 7 years of the death of the taxpayer, it will be chargeable. If there is tax to pay on that individual pet, i.e. we have either on this alone or with our cumulative to date, now seen that we've gone above the available nil rate band of 325. Then in which case, if there is tax to pay, the amount of tax that will be payable will be able to be reduced by taper relief. And that works on a sliding scale, as you see here in what is a very short section 5. And it shows you that if you had almost made it to the 7 years, you had lived for between 6 and 7 years of the date of the transfer to the date of death, then that would give you a taper relief, a reduction in the tax charge of 80%. We started by saying that if you survive for at least 3 years, some deduction, some taper relief would be available. So if it was between 3 to 4 years, you would get 20% reduction in the tax charge. And we then move in 20 percentage points. If you live between 4 to 5 years from the date of pet to the date of death, a 40% reduction in tax charge. 5 to 6 years, 60%. 6 to 7 years, 80% reduction. If you live for more than 7 years, of course, there is no chargeability anyway, because what was potentially exempt when made is now fully exempt. Now, we're only talking about pets here. If a taxpayer does not survive for 7 years following the pet, but does survive for at least 3 years, any IHT payable on the transfer is reduced by taper relief. The relief is available to the tax charge as follows. Now, as we said in our introduction a moment ago, we will just a little bit later in this lecture move into looking at the CLTs that were chargeable when made and may then also become chargeable on death. And if you have a CLT that is made within the 7 years of the date of death, but you survive for at least 3 years, but not the full 7, from the date of the transfer to the date of death, then taper relief would also serve to reduce any tax charge that would otherwise have arisen. How we compute that tax charge, of course, well, that's for later in this lecture. Got an illustration here. Illustration 10, again, we go back to information from the previous illustrations that we built up across a series of examples, and refer to illustration 7. But this time, the 2 lifetime transfers, they were both of £200,000, occurred. I've pushed these back in time, back to January 15 and June 17. Remember that went all the way back to illustration 2, I think it was. But the date of death of, I think it was D, our taxpayer here, the date of death was the 1st of February 2021. So, when you're told about the history of lifetime gifting, and we've got 2 lifetime transfers that were not transfers to the spouse or civil partner, and therefore would have been exempt. They are not transfers into a trust, that would have been a CLT. If it's not exempt, it's not a CLT, it's a pet. The only other transfers, all the other ones, are going to be pets. So we now look at the date of death, 1st of February 21, and go back 7 years from that date, which would take us to the 1st of February 2014. Are these 2 transfers within that 7-year period? Yes. 1st of January 15, well, January 15 and June 17 there, they're both within that period. So they are chargeable. If we had any pets that were prior to that date, 7 years before the date of death, if it were 7.5 years before death, 8 years as we had in a previous example, whatever, then any such pets more than 7 years before the date of death are now ignored in the IHT computation. It was not chargeable when made, it is not chargeable on death. What was potentially exempt when made has become exempt there. But these 2 are chargeable. What are we going to do? Compute the amount of IHT payable as a result of D's death at that date, the 1st of February 21. So, the computations that we do. Firstly, the lifetime transfers chargeable on death. For this, we require 2 columns, gross transfers, and then the amount, if any, of IHT that is payable in relation to that pet as a result of the death of the taxpayer. Which is the earliest within that 7-year period, January 15. As we know, it, as well as the June 17 transfer, they are pets. They're both 200,000. But the January 15 pet is the first such pet to become chargeable. So it benefits from the use of the full available nil rate band of 325,000. Hence, no tax to pay. If there's no tax to pay, taper relief is a total irrelevance. Taper relief, I stress, is a reduction in the tax charge. Taper relief does not reduce this, the amount of transfer, the amount that is chargeable to tax. Taper relief reduces this, the tax charge. There is no tax charge, so taper relief is irrelevant. But of course, we move on to June 17. Again, £200,000, but now only 125 of the 325 nil rate band remains available to us. That pushes, as we saw previously, 75,000 of this 200 transfer up into the 40% bracket, and therefore £30,000 of IHT would become payable. But we now notice the dates. June 17. As we know, it is clearly within 7 years of the date of the death of the taxpayer. But is it more than 3 years from the date of the death of the taxpayer? Well, June 17, start to count forward year by year. Still alive at June 18, 1 year. June 19, June 20, that therefore is 3 years. June 21, no. Died in February 21, didn't make it to June 21, therefore has survived for between 3 to 4 years from the date of the transfer to the date of death. As the pet falls between 3 to 4 years from the date of death, the tax charge may be reduced by taper relief. 3 to 4 years, you'll have your table, you probably won't need to use it. In the exam, you will know they move in 20 percentage points. 3 to 4 years is 20%, to 6 to 7 years being 80% there. So this is 20%. Now, this of course should be in line with the 30,000. It's a deduction therefrom. 20% of 30,000 is a £6,000 reduction, leaving it therefore with IHT payable of £24,000. That 24 on the pet will be payable, of course, by whoever was the beneficiary of that particular pet. And as we know, in relation to death, all tax becomes payable by as of a latest date, if you wish to avoid any penalties and fines, that is, at the latest date, 6 months after the end of the month in which the death occurred. Now, of course, that's the lifetime transfers, but of course, there's still the death estate. As in illustration 7, the nil rate band has been fully utilised on the lifetime transfers made in the 7 years before death. So the entire chargeable estate, that remember was £750,000, is taxed at 40%, giving you an IHT liability of 300. Now, of course, it would have been possible for a nil rate band to have been applicable against a part of that chargeable estate. We are, of course, referring to the residence nil rate band against the value of your main residence held within that chargeable estate. Now, we've seen this scenario many times before and hopefully recall the answer. That back in illustration 2 that begat all of these problems here, all these further illustrations, the main residence which did exist was actually left to, I think it was nieces and nephews, i.e. not a direct descendant. So on that basis, there is no residence nil rate band available to us. To summarise something we already know, it can now be seen that the amount of tax that arises on either transfers made in lifetime or on death cannot be computed in isolation because it's nothing to do with the circumstances of the donee. Remember what we've said all along? This is a cumulative donor-based tax. So it's all to do with the donor. IHT is a cumulative donor-based tax. Once again, in that example, there were two amounts, two pets, both constituting a gross transfer chargeable transfer value of £200,000, but because of the chronological order in which we apply our nil rate band, it meant that the first beneficiary of the first PET in January 15 paid no tax. The second beneficiary in June 17 was going to pay £30,000, but because of taper relief, that reduced it down to £24,000. At least some mitigation in that tax cost, but a very different outcome. It's a cumulative donor-based tax. Well, where we move next is to look at those CLTs. Before we do so, just go back and remind yourself about what you already know about CLTs. It's not much. How do you recognise one? What do we know about them in terms of when they are chargeable? How they're chargeable, that's what we see in this particular note. So pause, check back, obviously make sure you're happy with what we've just done in relation to taper relief, and then we'll go into a slightly more demanding computational area there. But again, as with all aspects of tax, there are rules. Rules that need to be learnt, rules that then need to be followed. Only practice, of course, will allow you to learn and then be able to apply them in any circumstance you see in the exam room. Well, it shouldn't have taken you too long, therefore, to revise back on the huge amount of knowledge that you have as regards what are chargeable lifetime transfers. And the only knowledge you have at this point is that what a CLT is. And that's a transfer made in lifetime into a trust. Again, you know the three types of transfer you could make in lifetime, whether they're exempt, whether they're now a CLT, or everything else which is a PET. We also know that with a CLT, IHT is chargeable at the date of the gift using the nil rate band in force at that date. They are chargeable when made. It means that if in addition to PETs and a chargeable estate given within your question, there are also CLTs, then before you can move on and do the two computations that we are, at the moment at least, familiar with, lifetime transfers chargeable on death and the chargeable estate at death, it will demand a first computation to be done dealing with lifetime transfers chargeable when made. What are they? They are only these CLTs. They are chargeable when made. Now, we talk about here using the nil rate band in force at that date. Our nil rate band of 325,000 we've had for 10 years. It's been there since 09-10 tax year, 2009-10. You'd have to go back to the 08-09 tax year to find a nil rate band that is actually less than 325,000. Now, although you may think, well, that's more than 7 years ago, so it wouldn't be relevant. Actually, what we're going to discover in discussing these CLTs is that that could still be relevant. And therefore, if you were to go back for transfers here made before 2019-20, the relevant nil rate band will be provided by the examiner. Now, as I said, from 09-10 onwards, it's been 325, but whenever it is, whatever earlier tax year, they'll tell you what the nil rate band is, even if it's just simple confirmation that in that tax year, it was actually still 325,000. But I've to go back, as I say, to 08-09 to find a figure lower than 325. If IHT is payable, it should be paid 6 months after the end of the month in which the transfer was made, but if later, the 30th of April, following the end of the tax year in which the transfer took place. So if later, the 30th of April, following the end of the tax year in which the transfer took place. So a little example provided here for us. If we had a CLT made in December 19, if of course, not to say that there will be any tax payable on it, again, we will have a nil rate band available to us, of course, here in lifetime. But for example, tax payable on CLT paid in December 19 will be payable by June the 30, 2020. Remember what the first rule was, 6 months after the end of the month in which the transfer occurred. the transfer was December 19, 6 months after that would be 30th of June 20. But if it had been later, we would have instead used the 30th of April following the end of the tax year. Well, that would have been the 30th of April 2020. That is not later. Therefore, June 30th is the later of the two dates. That is what you would use. Whereas, if the CLT had been made in June 19, then 6 months after the end of that month in which the transfer was made, 6 months after the end of June, that would have been the end of December. That would have been 31st of December 19. But if later, we use the 30th of April following the end of the tax year. That is April the 30th, 2020. That is later than the 31st of December 19. So IHT would not be payable until that date. We now use the term the gross rate of IHT on transfers, again remember, above the nil rate band. We still have these nil rate bands available. Even though these are chargeable when made, we use the nil rate band in force at the date, the tax year there in which the transfer was made. We talk about a gross rate to begin with, and that gross rate is 20%, i.e. half of the death rate. On death, any lifetime transfers chargeable on death, any chargeable estate at death go above the nil rate band, and as you know well by now, it's a 40% rate of tax. So the gross rate of tax payable on the lifetime transfers chargeable when made is 20%. Now again, I've used the word gross. Wherever you see gross, it implies there might be a net. More of that in a moment. 20% and is applied if the tax is being paid by the donee. The donee in respect of the trust, that's the trustees of the trust. So we need to know that if a question tells you, and it's going to tell you one of two things, but this first thing, if it tells you that the tax on the CLT was paid by the trustees of the trust, that means that the transfer was a gross transfer, and on the amount of that transfer above the nil rate band, obviously there's no tax up to the end of the nil rate band, but then the tax rate is 20%. If the tax is instead to be paid by the donor, now there's either of two parties who are going to pay the tax on this lifetime transfer. There is the settlor, the donor himself, that puts that transfer into the trust. That individual could say to the trustees, look guys, I'm going to make this transfer of X hundreds of thousands of pounds into the trust, or these assets like shares in quoted companies into the trust. And if there is any tax to pay on that, I, the donor, will pay it. Or as the donor, I could say, I'm going to make that transfer into trust of cash and or shares. And if there is tax to pay, you, the trustees, will pay it. Now, of course, don't panic at this point. It ain't going to be paid by the trustees out of their money. The trustees, they hold the purse strings of the trust. So it is the trust that will bear the cost of that tax. The trustees simply sign the cheque or make the transfer there to HMRC in relation to that tax charge. Now then, we need to recognise on any CLT who has paid the tax to know whether we're dealing with what we refer to as a gross transfer or as a net transfer. If the tax is instead to be paid by the donor, the transfer is said to be a net transfer, and the gift has to be grossed up, as the IHT payable by the donor effectively becomes part of the gift. Let me break that sentence down. If the tax is being paid by the donor, how do we know whether it's paid by the donor or by the donee, i.e. the trustees? 9 times out of 10 in exam questions, the question tells you the tax payable on this CLT and or that CLT was paid by, and either it will be by the trustees or it will be by the donor, the taxpayer himself or herself, who has made that transfer into the trust. So, if the trustees are paying it, it is a gross transfer. If the donor is paying it, the amount of that chargeable transfer is said to be a net transfer. And from it, we need to be able to work out what the gross amount would be. We'll see how we do that in a few moments' time there. But sometimes, I've said 9 out of 10 times, the examiner will tell you whether or not it is effectively gross or net by telling you who has paid the tax, trustee or donor. But sometimes you get the question where it doesn't tell you who has paid the tax. What do you do then? Simple. Where no statement has been made as to who pays the tax, you will assume that it is the donor that makes that payment of tax, and therefore it is, all that we're just calling it at the moment, don't know what it is, but that is a net transfer. It is a net transfer. So either the question tells you, or if the question is silent as to who pays, you assume that the donor, the settlor, that individual pays the tax on the transfer into the trust. That therefore makes it a net transfer. How we then do the calculations we'll see in a moment's time. Now that's not just some random assumption. You don't need to know this, but what exists in reality is if the trustees are to make the payment of tax, then they must elect so to do. Now they will do so if the settlor tells them to. Remember, the settlor will be the principal named trustee within the trust. The tax is either going to come directly out of the settlor, the taxpayer's own pocket, or indirectly from them, because the amount they put into the trust, some of that is then used to pay the tax. So there's less now gone into the trust for the eventual benefit of whomsoever may be the beneficiaries of that trust. If, therefore, the trustees, as they do, need to elect to then have it treated as a gross transfer, that they pay the tax, if there is no mention in the question, then that can only mean that no such election has been made. And if no such election has been made, then it must be the donor that pays the tax. So if the question is silent, assume it is a net transfer, that the donor has paid the tax. We will see in a moment's time, therefore, how we compute the tax. As regards how we deal with those net transfers, we won't yet understand this. We'll explain it more as we go through. But the simple solution to this problem is to apply a net rate, IHT rate of 25% to any part of the net gift in excess of the available nil rate band at that date. The gross amount of this transfer is then computed by adding the amount of IHT. If you take the net transfer, add on the IHT, that gives you the gross transfer. How we do that, we'll look at it in a moment there. The concept of why it is a net transfer, that was this little statement here. We know that the chargeable transfer is based on an original transfer of value. And the transfer of value is the difference between what I have before the transfer and what I have after the transfer. Now, if I make a transfer into a discretionary trust, or whatever other name the trust may be given, but into a trust, don't worry about the word discretionary. If I make a transfer into a trust there, then if it is cash, whatever cash it is, 100,000, 200, 300, 400,000 pounds, that is a diminution in the value of my estate. Whatever cash I put into the trust's bank account there. But if, of course, I then also have to pay the tax on that transfer, that further diminishes the value of my estate. So that too is a part of this overall chargeable transfer. So what I've got to do is to work out what is my net chargeable transfer, what is the tax thereon, put the two together to give me the gross. Now, it sounds more difficult than it actually is, as we'll see, I hope, with the workings that are now to follow. So let's look at illustration 11. Right, our heroine here, our hero, heroine, I don't know whether you call, again, female heroes heroines these days, but KBAB, remember, it's a donor-based tax. Donor KBAB. KBAB made a chargeable transfer into a trust of £400,000. When? In June 16. She has made no previous lifetime transfers. Remember, IHT is a cumulative donor-based tax. More of that as we go through this section. The nil rate band, as you already know anyway, back in the tax year 16-17, was 325,000. So we've had that since 09-10. And what we've got to do, compute the amount of IHT payable, assuming firstly that the trustees paid any IHT due. After we've dealt with that, then we'll deal with what would have happened if K, the donor, had paid any IHT that was due. So the name of the computation, this time headed lifetime transfers chargeable when made. Again, the same two columns as when dealing with pets, gross transfers, and then the amount of IHT that may be payable on any of those lifetime transfers. But we've also got here a little working column into which, for the CLT, whatever date it was, this was June 16, there we put in the amount of the chargeable transfer. The amount of that chargeable transfer is the transfer of value less any lifetime exemptions. We haven't yet discussed what these lifetime exemptions are. We've had vague reference to it, but in the next lecture we will see what those exemptions are. They are obviously, as exemptions, deductions that may be available, but only if, of course, you qualify for that particular exemption. What qualifies us for any such exemption, we see, as I say, in the next lecture together. But here, this is the amount of chargeable transfer. And whoever is paying the tax on this transfer, it doesn't matter. That chargeable transfer is the transfer of value less your lifetime exemptions, giving you chargeable transfer. Right. Remember, it's a cumulative donor-based tax. She had made no previous lifetime transfers. We need to know that to understand that as there were no previous lifetime transfers, specifically within the 7 years before this date, it means that there has been no prior usage of the available nil rate band. So it means that the whole 325,000, the nil rate band available in the 16-17 tax year, remember this was chargeable when made. We didn't know in 2016 that come the 19-20 tax year we'd still have the same £325,000 nil rate band. So you use the one there. There'd been no CLTs in the previous 7 years. Therefore, all of the then available nil rate band, 325,000, is available. So that would be, of course, at nil. The gross chargeable transfer itself, the chargeable transfer figure, was 400,000. So that's another 75,000 to be taxed at 20%. Why 20%? This is a gross transfer because the trustees have elected to pay any IHT due. So if the trustees pay, it's a gross transfer. The amounts above the nil rate band will be charged at 20%, the gross rate 20%. So do as we've always done. We need, in dealing with any lifetime transfer, to know what happened in the previous 7 years. We've been doing that in relation to the date of death when taxing the lifetime transfers chargeable on death. What we're now looking at is lifetime transfers chargeable when made. So were there any CLTs, and we'd only be interested in CLTs, made in the 7 years before June 16? No, there were not. Therefore, we've got the full 325 then available nil rate band. 75,000 at the gross rate of 20% is £15,000. Now, because it's a gross transfer, that 400 goes into your gross transfers column. You know that is the gross figure. What is the tax figure? 15,000. That goes into your IHT payable column. Right. What about then if K, the donor, paid the tax? Then we would call it a net transfer. So what now would go into our columns? Well, if K paid the tax, still the first 325 is within the nil rate band. So whether it's gross or net is only an issue if the amount of this lifetime transfer, this chargeable transfer figure, takes you above, for a period of 7 cumulative years, above the then nil rate band, likely to be, of course, the 325,000 that still currently exists. So if K paid the tax, then the first 325 is still within the nil rate band, but we've still got an excess of 75. It's at this point you need to know who pays the tax. Where it was the trustees, the 75,000 was taxed at a gross rate of 20%. Where it is K, because it's a net transfer, it's now taxed at 25%. The tax is then added to the 400,000 to establish the gross amount of the gift. So again, in your working column, what was the amount of the chargeable transfer? £400,000. How much of that is above the then available nil rate band? 75,000. Who pays the tax? K does, the donor. That means it is a net transfer, and where it's a net transfer, we use a net rate of 25%. 25% of 75,000 is hopefully 18,750. Put the 18,750 again into the tax column. But now we're saying that the 400,000 was a net transfer. So how do we get the gross amount? The tax is then added to the 400,000 to establish the gross amount of the gift. 400 plus 18,750, 418,750, the gross figure. Now, given that we're tackling objective testing questions, so there are no marks available in relation to the computations, you may think that, well, all I need to know is that figure. And if the only figure they wanted was the amount of tax payable in lifetime on the CLT, that would be fine. But if we're dealing with a Section B problem that takes you from what are the lifetime transfers chargeable when made, these CLTs, and how much tax was payable, here you needed to know, was it a gross transfer, was it a net transfer? And you need to establish the gross amount of such transfers, either 400 or now in this case 418,750. Because what may then happen is that you've also got to compute the IHT that is payable on the death of the taxpayer. And that means that when dealing with the lifetime transfers chargeable on death, we cast our net back initially 7 years. Those transfers now, both PETs and CLTs that fall within the 7 years prior to the date of death, they become chargeable as a result of the death of the taxpayer. And you need to know what figure to put into that computation on lifetime transfers chargeable on death for the CLT. And the figure that we'll always be using is the gross amount. So you need to know whether that gross amount is 400,000 or is 418,750. How do we know whether it is gross or net transfer? Who pays the tax? Who could that be? Either the trustees, in which case the amount of the chargeable transfer is the gross amount of the transfer. That is what will be used for cumulative purposes in any other parts of our IHT computations. If the donor, the settlor, the taxpayer concerned, here K, made the payment of the tax, then the transfer here of 400,000 is a net transfer. Therefore, you add to it the amount of tax charged thereon to give you the gross transfer. The idea here of that excess above 325, tax at 20% if it's gross, tax at 25% if net, is the simple and easy basis of doing it. Again, it's a simple exercise, which you know from your income tax studies. If we had a gross amount of £100,000 and we had £20,000 tax thereon, that is tax at 20% on the gross figure, then the net amount of that would be 80,000. If therefore I'm given a gross figure to compute the tax, I tax at 20%. If what I've been given is a net figure, how do I get that tax? I don't take 20% of 80,000. 80,000 is times by 25%, which of course would then equal £20,000, and there is the self-same tax figure. Now, again, what lies behind the maths really doesn't matter. All you've got to do is to learn how to recognise when it's gross, when it's net, and to understand then that if you go above, as you will on one or other of the CLTs to deal with, you go above the available nil rate band at that point in time, at that date when the transfer was made, then any excess above then the available nil rate band is going to be taxed at either 20% or 25%. 20% if the trustees pay the tax, 25% if the donor pays the tax. Okay, those are the rules. As a CLT is immediately chargeable to IHT, it goes into the donor's IHT accumulation, using up his nil rate band for the next 7 years. Now, as we've already said, I'll come back to this point in a moment, but if the donor dies within 7 years of a CLT, additional death tax may be due to top up the lifetime tax paid. The IHT liability is calculated in the same way as the tax is on a pet, with credit given for taper relief, as it would be with a pet, i.e. the CLT or the pet is within 7 years of the death of the taxpayer, but is more than 3 years from the date of the taxpayer. But of course, unlike with pets where there was no lifetime tax that was paid, here with CLTs there may be, and therefore any lifetime tax paid is also deducted, the basis of which we'll see in a moment. But to go back to this, as a CLT is immediately chargeable to IHT, it goes into the donor's IHT accumulation, using up his nil band for the next 7 years. So looking at our example here, let's try to make some of this a little bit clearer now. Looking at our examples here, that here in June 16 there'd been this chargeable transfer of 400,000. Exactly the same number whether or not the donor or the trustees paid the tax on that transfer. Based on whether it was gross or net, we computed the amount of tax and with it the gross amount of transfer. And that becomes a part of this accumulation exercise that we're doing here. Now, both of those figures are of course in excess of 325,000. And what that means is, if the nil rate band that then was 325,000 is still 325,000, but if there is a further transfer made within 7 years of that date, so that CLT was June 16, 7 years on plus 7 years there, would take that to June plus 7, 23, June 2023. If before June 23 you made another CLT and the nil rate band still remained at 325, or it had not exceeded the gross amount of transfers that you see there on the computation as of June 16, if that up till June 23 nil rate band doesn't change, then you know that all of the nil rate band is deemed to have already been used. What does it mean? It means that the next CLT, anything between June 16 to June 23, with now on this taxpayer's clock here, a figure of either 400,000 or 418,750, both in excess of the available nil rate band of 325. It means whatever figure of CLT chargeable transfer you get next time, it will all be taxable. The only question again is who's paying the tax. So to that figure, all of the chargeable transfer, do I tax it at 20%? Do I tax it at 25%? So again, this cumulative donor-based tax principle comes into play. We cannot look at individual pets in isolation. We cannot look at individual CLTs in isolation. With CLTs, as you go through lifetime, you make a CLT. If it is the first CLT, as this is, then that's fine. You've got all of the then available nil rate band. But if you make a further transfer within the next 7 years, like on death, we work on a 7-year accumulation principle. So between June 16 and we say June 23, then we've already been deemed to use either 400 or 418,750 of any nil rate band. So only if the nil rate band, which it's not going to, would have gone above that, would you then be able to use any more nil rate band. So what it means is it's all going to be taxed. It's then back to the same question. Once you know it's all taxed, it's all above the nil rate band, who pays? Is it gross? Is it net? Is it 20%? Is it 25%? Okay. At this point though, we've worked out the lifetime tax. What happens then if the taxpayer dies? And that takes us to the last of the illustrations that we'll include within this particular lecture, illustration 12. Having made the chargeable transfer of £400,000 into the trust in June 16, Kay then died in December 20. June 16, December 20. December 20 is within 7 years of the date of that CLT. Therefore, what has already been chargeable when made, because it's within the 7 years before the date of death, will also be a part of the computation, a computation that we should know well by now, that will be headed up and dealt with on death, lifetime transfers chargeable on death. And she left a chargeable estate of £1 million. Compute the IHT payable on the transfer into the trust as a result of Kay's death. Assume that the trustees paid the tax payable in lifetime as shown in illustration 11. So in illustration 11, it was the first of the two scenarios that we were dealing with. You'd already have done this computation, lifetime transfers, here chargeable when made, and you'd have established that the gross amount of the transfer was 400,000 and the amount of IHT paid in lifetime was 15. Both numbers that we need to know. We're now dealing with, on death, what is the tax payable as a result of the death of the taxpayer, as a result of Kay's death, lifetime transfers chargeable on death. Now here, there's no pets, there's just this single CLT. Was it within the 7 years before the date of death? Yes, the date of death was December 20. That means we'd have gone all the way back to the relevant date in December 2013, 7 years before this, on our cumulative 7-year working. June 16, what was it? A CLT. Now we don't need any further working column, we just need what was the gross transfer. We know now what was the gross transfer, it was £400,000. On death, as a result of death, this transfer has become chargeable. What is the nil rate band available at the date of death? When doing lifetime transfers chargeable on death, the nil rate band you use is likely to be the same anyway, but it is the one in force at the date of death that you use, not the one that was in force at the date of when the CLT was made and was first chargeable. On calculations of tax due on death, it's always the then available nil rate band that you use. That's 325,000, pushing 75,000 up into the 40% band, and that equals 30,000. So there's your first figure. So if you'd been told that there was a pet where you had a gross transfer value of 400,000, that was the chargeable transfer figure, you'd have done exactly the same calculation as you see there. What you'd also do with the pet, and you now do it for this CLT as well, is to say, well, hang on a minute, June 16, that is more than 3 years from the date of death. Therefore, taper relief is available as a reduction in that tax charge. The tax charge is now reduced by any available taper relief, just as we would with pets, but also then by any lifetime tax that was paid, but in this order. Firstly, the taper relief. So, get your fingers out and start counting. The date of this transfer, June 16. So, did we survive to June 17? Yes, we did. June 18, June 19, June 20. When was the date of death there? The date of death, December 20. So you did survive till June 20. Do you get to June 21? No, you don't, because you died in December 20. So you've survived for between 4 to 5 years. 4 to 5 years is taper relief of 40%. 40% of 30,000 equals 12,000, bringing you down, therefore, to a figure of 18,000. And only once you've applied, if it's applicable, the taper relief, do you then deduct, get these in the right order, it is important, the lifetime tax paid. That was the other figure that we said that we would need, the amount of lifetime tax paid. How much was it on this calculation? £15,000. Back we go. £15,000 is the deduction from 18, meaning that the additional tax that is due on death is £3,000. You do not end up with a CLT having paid both 20% if it's the gross rate applicable at the time that the transfer was made, chargeable when made, and 40% tax rate on death. The maximum you can pay is a total of 40%. That's the maximum. If you have already paid some tax in lifetime, there was a gross rate in lifetime of 20% there, then any such lifetime tax is indeed a deduction from the tax due on death, to be applied, as you see here, after taper relief. But if, of course, we'd made the date of that transfer 1 year earlier, so if the lifetime tax paid exceeded the amount of tax now due, in this example, if the CLT had been in June 15, then the taper relief would have gone up to 60%. We'd now have survived for between 5 and 6 years. And if you took 60% deduction here, then that 60% of 30 would be an £18,000 taper relief. That would leave you with £12,000. But the lifetime tax you paid was 15. What happens? It's left a liability of only 12, so that after deducting the lifetime tax paid, no additional tax would be payable. No additional tax. But equally, there would be no repayment of lifetime tax paid either. The best that that lifetime tax can do for you is to reduce what would have been a charge on death down to nil. It can't create a repayment for you there. So get them in the right order. Again, therefore, we now see CLTs that are chargeable when made. That is the first of now 3 computations that you could be called upon to deal with. Lifetime transfers chargeable when made, where you only deal with, in your accumulation principle, with CLTs. We had just one of them here. We only deal with CLTs. If then the taxpayer dies 2 further computations, as you know, then become required of you. They are lifetime transfers chargeable on death, and then the chargeable estate at death. The tricky parts there, dealing with the CLTs, lifetime transfers chargeable when made, potentially for lifetime transfers chargeable on death, combining them with those pets that have occurred within the 7 years of the date of death as well, where again you go back to the earliest transfer within the 7 years before death and come forward, applying your available nil rate band in that order. And obviously we'll have further exercises later on in this chapter to be able to take you through some of the more, shall I call them, interesting scenarios that we might see. Okay, that brings this particular lecture to an end, therefore you'll be happy to hear. You will need to spend some time going back over that and seeing the basis of the workings that we've done to get your head around them. Next time, well, we've spoken of lifetime exemptions being deductible from the transfer of value to give you the chargeable transfer figures. In every IHT computation we've done so far, we've picked up a chargeable transfer figure. I've given it to you. What we need to understand is that you might have to work that figure for yourself. You already know how to compute a transfer of value, the diminution in the value of the estate of the donor. If there's no lifetime exemptions to apply, then the transfer of value is the same as the chargeable transfer. But if any of those lifetime exemptions are available, that will reduce the transfer of value down to a lower figure of chargeable transfer. It is that chargeable transfer figure that goes to the computations that we've been looking at up until now. That's the figure to include within the IHT computations, whether that is lifetime transfers chargeable when made, lifetime transfers chargeable on death. Those lifetime exemptions will have been deducted. You may have to do that for yourself. So next time we'll have a look at what those lifetime exemptions are.